You know that feeling? It's Thursday afternoon. You've just been paid, and for a few glorious hours, you feel rich. You look at your bank account, and the numbers look solid. You feel like you could finally buy that new thing you've been staring at online, or maybe just treat yourself to a really nice dinner without doing the mental math of how much rent is left. So you swipe your card, you tap your phone, you go about your life, and then, seemingly out of nowhere, 3 weeks later, you're checking that same app and wondering, wait, where did it all go? You didn't buy a yacht. You didn't suddenly invest in failing stocks. You just lived. You bought gas, paid for groceries, maybe covered a surprise car repair. But the speed at which the money evaporates, it feels unnatural. It feels like there's a leak somewhere in your pocket that you just can't find. And the crazy part is, while you're stressing about why the balance hits zero so fast, the place holding your money isn't just sitting there watching it happen. They are actively, quietly, and very efficiently profiting from that entire cycle. They're making money, on your debt, and even on the mistakes you make when you're tired and not paying attention. My name is B.O.B., and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others stay stuck in the same financial patterns for decades. And here's the thing that used to keep me up at night. Why is the system designed so that the people who need the money the most, people who are working hard, trying to save, trying to get ahead, are the ones who end up paying the most just to access their own funds? It's not an accident. It's a design. Today, we're going to take a look at the 10 silent ways banks extract value from you. And I'm not talking about the obvious stuff like monthly maintenance fees. Everybody knows about those. I'm talking about the hidden mechanics, the psychological traps, and the mathematical quirks that most people miss. Once you see these things, you honestly can't unsee them. And understanding them, that's the first step to stopping the leak. Let's dive in. Okay, let's start with the big one. The granddaddy of banking profits. To understand how banks make money off you, you have to understand how they view the money you give them. When you deposit your paycheck, let's say that $1,500 from the intro, you probably think, okay, that's my money. The bank is keeping it safe for me in a big vault, and when I need it, I go get it. That is a nice, comforting thought, but it's basically a fairy tale. In reality, when you hand your money to a bank, you're technically lending it to them. You become an unsecured creditor. And thanks to something called fractional reserve banking, they don't keep your money in the vault. They keep a tiny fraction of it, literally pennies on the dollar, and they lend the rest out. Here is the kicker. They lend your money to someone else to buy a house, or a car, or to start a business, and they charge that person interest. Let's say they charge 6% or 7% interest on a mortgage. That money they're earning, it's being generated using your capital. But are you getting a cut of that 7%? Absolutely not. You're getting, what? 0.01% if you're lucky? Maybe 4% if you have a high-yield savings account right now, which is rare. The spread, that difference between what they pay you to borrow your money and what they charge others to borrow it, is their profit margin. It's basically arbitrage. They are selling the same product to two different markets at vastly different prices. They buy money from you cheap, and they sell it expensive to someone else. What this means for you is that inflation is eating your savings alive, while the bank uses your purchasing power to generate real wealth for themselves. You're holding the bag, and they're running off with the value. So, let's move from your savings to your spending. Because, honestly, this is where it gets a bit predatory. Have you ever looked at your credit card statement? At the bottom, there's this little box that is the most dangerous thing in the financial world. It says two things. It says statement balance, which is the total you owe, and then it says minimum payment due. That minimum payment number looks so appealing. If you owe $3,000, the minimum might be like $40 or $50. Your brain goes, oh, I can afford $50. That's easy. I'm fine. I'm managing. Here's what banks are hoping you miss. The mathematics of that minimum payment are designed to keep you in debt for decades. Literally decades. If you only pay the minimum on a standard credit card, the interest is calculated on the remaining principal, which barely goes down because most of your payment is going toward the interest, not the actual balance. You could be paying for a dinner you ate 5 years ago right now. That steak is gone. The memories have faded. But you're still paying a premium for it every single month. Banks love this. This is their bread and butter. They don't want you to pay it off. They want you to be a forever customer. They call this revolvers in the industry, people who carry a balance month to month. And they make billions off the fact that humans are optimistic creatures who think, I'll pay more next month. Next month comes, life happens, you pay the minimum again. It's a trap. The fix? Ignore the minimum. Treat the minimum payment like it's a trapdoor. Look at the total balance and feel the pain of it. You need to feel that pain to stop the cycle. I remember when I got my first credit card. I thought I was so grown up. I bought I think it was a new monitor for my computer. It was like $300. I thought, oh, I'll just pay the minimum. 6 months later, I realized I had paid $300 in payments and still owed $280. I felt like I'd been scammed. And honestly, I had. I just didn't read the fine print. Let's talk about something that makes my blood boil. Overdraft protection. Banks market this as a feature. They say, hey, sign up for this. If you try to buy something and you don't have enough money, we'll cover it for you so you don't get embarrassed at the grocery store. Sounds helpful, right? Like a safety net. But think about what they're actually doing. You swipe your card for a $5 coffee. You don't have $5 in your account. The bank steps in and pays the $5 for you. And then, instantly, they charge you a fee, usually around $35. So, that $5 coffee just costs you $40. That is not a safety net. That is a loan with a 700% interest rate. And here is the sneaky part. They use to process transactions from largest to smallest, not in the order you made them. Let's say you have $50 in your account. You buy a coffee for $5, a gum for $2, and then later you try to buy a textbook for $60. If they process the $60 first, you get hit with an overdraft fee. Then the $5 coffee and $2 gum come through, and those also trigger fees because your balance is now negative. Instead of one fee, you get 3. It's brilliant for them and terrible for you. They've made a fortune on people living paycheck to paycheck. The only way to win this game is to opt out of overdraft protection entirely. Would you rather your card get declined at the register, awkward, sure, but free, or pay $40 for a sandwich? I'll take the awkwardness any day. This one is classic marketing. You get an offer in the mail, 0% APR for 18 months, or balance transfer for 0% interest. It looks like free money. You think, yes, I can move my debt here and pay it off interest-free. And if you're disciplined, that can work. But banks know human psychology better than you know yourself. They know that when you see 0%, you stop worrying about the balance. You relax. You might even spend a little more because, hey, no interest. Then the time bomb ticks down. Usually, at the end of that introductory period, the interest rate doesn't just go to a normal level, like 10% or 15%. It often jumps to a penalty rate, sometimes 25% or 30%. And here is the clause they know you'll miss. Deferred interest. On some of these cards, if you don't pay off the entire balance before the 18 months is up, they don't just start charging interest on what's left. They retroactively charge you interest on the original balance, going all the way back to day one. You thought you were being smart, paying down $2,000 of a $3,000 balance. On month 19, you realize you now owe $4,000 because of the back interest. It's a trap. It's designed to catch the people who are trying to do the right thing, but miss one deadline. Okay, let's switch gears to something a bit more subtle. The annual fee. I have friends who are obsessed with travel points. They love their gold or platinum or titanium cards. They pay $500 a year just to have the privilege of carrying this piece of metal in their wallet. Now look, if you're a super traveler and you maximize every single perk, the lounge access, the credits, the points, that fee might pay for itself. But for most people, it doesn't. Banks make a killing on these fees because of this sunk cost fallacy. Once you pay that $500, you feel like you need to use the card to get your money's worth. So you stop using your debit card or your cashback card. You start swiping the metal card for everything. But the points system is tricky. You might spend $5,000 just to get a $100 credit. It's not free money. You spent money to get money. And the bank? They're taking a cut of every transaction you make from the merchant, plus your annual fee, plus the interest if you carry a balance. If you aren't doing a spreadsheet every month to calculate your return on investment on that card, you're almost certainly losing money. The bank knows you aren't doing the spreadsheet. They are betting on your ego. They know you like the feeling of putting a heavy metal card on the bar. This one drives me crazy because it's just annoying. You need cash. It's an emergency, or maybe it's just a cash-only place. You see an ATM that isn't your bank's. You know it's going to cost you. You put your card in, and it asks, "This machine charges $3. Do you accept?" You're desperate. You hit yes. You take out $20. The machine gives you the cash, and your bank charges you another $2.50 for using an out-of-network ATM. So, to get your own $20, you just paid $5.50. That is a 27.5% tax on your own money, just for the privilege of touching it. Banks act like this is for maintenance costs. In 2024, with digital transactions, it costs them pennies to process an ATM withdrawal. It's almost pure profit, and they share that profit. The ATM owner gets a cut, your bank gets a cut. They are both passing the hat in your pocket. It's the ultimate petty cash grab. It's not enough to bankrupt you, but it's enough to make you resentful. And it adds up. If you do that once a week, that's $280 a year. Gone. Just vanished into the digital ether. You know, it's funny, we get angry at the government for taxes, but we just accept these private taxes from banks like it's just the cost of doing business. It's not. It's the cost of being unprepared. So, you miss a payment. Maybe you were traveling. Maybe you just forgot. It happens to the best of us. You log in and realize, oh no, the due date was yesterday. You get hit with a late fee, usually $25 to $40. Annoying, but manageable, right? Here is what most people miss. That late fee isn't just a fee. It's a trigger. It can trigger what's called the penalty APR. Even if you have a low interest rate, if you're late, sometimes even on a different account, your bank can check your credit report, see the late payment, and instantly jack up your interest rate to the maximum allowed, often 29.99%. This is called universal default. You might be late on your electric bill, and your credit card company can use that as an excuse to raise your rates. It's legal in many places, and it's brutal. Suddenly, your debt becomes twice as expensive to carry because of one mistake. And once they raise that rate, it is incredibly hard to get them to lower it back down. You are now a high-risk customer in their eyes, and they're going to treat you like one by charging you more. You finally saved up. You're going on a trip to Europe or Japan or somewhere amazing. You're excited. You land. You go out to dinner. You pay for the meal with your card. You come home, check your statement, and you see charges that are 3% higher than what you signed for. Banks charge a foreign transaction fee, usually around 3%, on every purchase you make outside your home country. They claim it's to cover the cost of converting currency. Again, in the digital age, that's nonsense. The currency markets are digital. It costs them nothing to convert a euro to a dollar instantly. They are charging you because they know you are vulnerable. You're in a foreign country. You don't want to carry wads of cash, and you aren't going to read the fine print on your card agreement while you're waiting for the Eiffel Tower elevator. It's a stealth tax on your vacation. On a $5,000 trip, that's $150 straight to the bank's bottom line, just for letting you swipe your plastic in a different time zone. We touched on this earlier, but let's go deeper. This is the silent killer of wealth. You have $10,000 in a savings account. The bank pays you 0.5% interest. That's $50 a year. $50. You can't even take a date to the movies for $50 anymore. Meanwhile, inflation is running at 3% or 4%. That means your $10,000 is losing purchasing power every single day. In real terms, after fees and inflation, that money is rotting. The bank knows this. They are economists. They have data scientists. They are perfectly aware that by keeping your money in a standard savings account, you are getting poorer. They do this because they want that money cheap. They want to borrow it from you for pennies so they can lend it out for dollars. It is the oldest trick in the book. The sad part? Most people leave their money there because it feels safe. And sure, the nominal number doesn't go down. But you can't buy groceries with nominal numbers. You buy them with purchasing power, and that is leaking away. This last one is the one people completely forget about because it doesn't show up on your statement. When you bank with a massive institution, you are giving them a map of your life. They know where you shop, how much you spend on food, how much you spend on entertainment, your doctor's visits, your travel habits. They know more about you than your spouse does. They package this data and sell it, or they use it to market products to you. Have you ever noticed how your bank's homepage or app always has a banner suggesting a loan right around the time your balance dips? Or how they suggest a credit card when you're looking at flights? That's not a coincidence. They are mining your transaction history to figure out how to sell you more debt. They are monetizing your privacy. You are the product. It's why, honestly, smaller credit unions or local banks can sometimes be a better option, not just for fees, but because they aren't building massive surveillance empires on the back of your grocery list. So what does that leave us? We've gone through 10 different ways your bank is picking your pocket. It's easy to feel overwhelmed. It's easy to feel like the game is rigged. And honestly, it kind of is. The system is built by people with MBAs and supercomputers to extract maximum value from average people who are just trying to live their lives. But here's the thing. Once you see the strings, you can stop being a puppet. You can opt out of overdraft protection. You can pay more than the minimum. You can look for a high-yield savings account that actually gives you a fighting chance against inflation. You can read the fine print on those 0% offers. It's not about being perfect. I've paid late fees. I've paid ATM fees. We all have. It's about awareness. It's about moving from being someone who just uses the bank to someone who manages their relationship with money. It's a subtle shift in mindset. You stop seeing the bank as a safe place where you hide your money and start seeing it as a service provider that needs to earn your business. Because here is the truth nobody tells you. Your money is your energy. It's your time converted into value. You traded hours of your life for that money. When you let a bank take huge chunks of it through hidden fees and low interest, you are literally giving away your life. That might sound dramatic, but think about it. How many hours did you have to work just to cover that overdraft fee? Was that hour of your life worth the $40 you gave to a CEO's bonus? Probably not. You can change this. Not by getting angry, not by storming the gates, just by paying attention. Read the statements. Ask the questions. Shop around. There are good financial tools out there. There are banks that treat you like a partner, not a piggy bank. You just have to be willing to look for them. So, next time you open your banking app and see that balance, don't just look at the number. Think about where that number is going. Think about who is benefiting from your hard work. And then make a choice to keep a little bit more of that value for yourself. You've earned it. Thanks for watching, and I'll see you in the next one.